Hello everyone, my name is Ram Dhamija. Welcome to my channel. Today is 16th of November, Sunday, and the markets are looking just fine. It's been 1 week of quite high volatility due to the state elections. Now that the elections are behind us and the result was to the market's liking, it looks like the market should now take some calm from here and things should settle down. And we are now hopefully guided by the results and the other factors which determine the market direction rather than some external factors. Everything is looking all right now as we speak. The market was, as I said, was highly volatile in the last 1 week, and especially one day before the election results. We saw heightened volatility in Nifty, and during that day all the options actually went completely wild. In fact, the premium also increased that day. In fact, the good thing was that all those things were taken care of during the election result day, wherein since the morning only the results, even before the market opening, the results were very clear, and after that market kind of stayed within a range, and all the options volatility also went off. So that was one good thing that happened the other day, especially from an option selling standpoint. There are other things which have happened in the market over last 1 or 2 days. One is that the open interest, which was highly positive, is now slightly below 1. So that is something that we need to watch out for. There has been a huge sell-off in cryptocurrency and also some sell-off in US markets. Now, why am I bringing this up is because, of course, everything is driven by liquidity, worldwide liquidity. And if cryptocurrency as a market completely collapses, I don't know whether that's going to happen or not, but the initial signs are not good. In fact, I will show you last 1 week, 1 month, 3 months, 6 months, and 1 year return of Bitcoin have actually gone into negative. So that is not something which is a great sign. So Bitcoin, is now below 95,000, and at some point in time, if this breaks, then there is huge amount of liquidity, that is about 2, 3, 5 trillion dollars. I'm not even sure how much. What is the current market capitalization of just the Bitcoin? If that money gets into trouble, then it will have some collateral damage as well, because what has also happened is that now in crypto there are ETFs, there are mainline banks in US, etc., which have got involved. And once that part is that part of the market doesn't do well or collapses or whatever, then it's going to have some collateral effect as well. I'm not saying that's happening now, but the signs are not good. So that is one problematic area. US markets, which are extremely overheated, they corrected a lot. So we saw that NASDAQ and S&P, etc., have gone into some sort of a correction. The big Max 7 companies have gone into some sort of a correction. So a lot of these things are playing out, and that is going to have some effect. But what actually happened was that from April bottom, US markets went up by 60% in the last 6-7 months. So some sort of a pullback is expected over there. And for us, the situation is completely different, because for us, last 1 year returns have actually been flat. Though if you see November to November, now we are showing some gains because the correction had set in last October. But otherwise we haven't still taken out our highs of September. So for us, the returns have been flat, and if the world markets fall, then we are also going to fall with it. But my point is that if the world markets fall and if our markets also fall along with it, then the valuations that our markets command are going to become even more attractive, and that perhaps is a very good time to get into the markets if anyone has not gotten into the markets. If anyone has not gotten into the markets, any time is good, I would say, because last 1 year correction has happened. But if markets go down further from here, then the situation is going to become even more appealing, when the valuations will even come down further. Both time and price correction would have happened. So just turn back the clock a bit to March 23. So March 23, then the last bull run actually started. The previous peak was made in September 21. So from September 21 till March 23 was the time when the correction was happening. So if, let's say, we take the same analogy this time, September 24 the correction started. Is it going to go on till March 26? I don't know. But if it does, then it's going to be a very good base formed for the next leg of the bull run. So let us see if that happens. So I'll take you through all these things in today's video. There's a lot of action packed in today's video. But before I begin, two things. One is, if you have not subscribed to the channel, please do that. And second is, if anyone wants to get their mutual fund portfolio evaluated or made, they can contact me through the Google form. I am a AMFI registered mutual fund portfolio distributor, and I help people evaluate their mutual fund portfolios and also create them free of cost. So if anyone is interested, they can fill up the Google form. Now let us begin today's video. This is the Nifty chart, as you can see. As I had said earlier also many times, that Nifty is going to consolidate in a zigzag pattern for some time, and you can see that we have been going up, going down, going up, going down, and that pattern is continuing. So till the time this pattern continues, there is nothing much to worry. It's just that we should not cross these boundaries. On the lower end, it is somewhere around 25,300. That we should not break, because if we break that, then there's a problem. But till the time we are in that particular range, it is absolutely fine. The support, as you can see, is going to come somewhere around 25,600 odd levels. That will be the first support, and if we are not able to hold that, then of course the ultimate support should be the last bottom that was made from where we reversed, which is 25,300. But a word of caution over here, even if we go down below that, even if we, let's say, go to 25,000, okay, which is the next big support, one should not panic, because it is just part of normal correction, normal healthy correction. 3%, 4%, 5% correction here and there doesn't make a huge difference in the long-term trajectory of the market. So in fact, any correction should be seen as a buying opportunity. Any correction, if you buy during the dips, your long-term CAGR, if your portfolio actually increases by 1 to 2%. So not many people are aware about this thing. Many people will put their SIPs and forget about it. In fact, for my clients, what I advise them to do is that any sort of correction that happens, put whatever little money you have, and when the markets actually go up, all those things work out. For example, if you saw during wars like India-Pakistan war happened, the market had dipped a bit. Iran-Israel war happened, the market had dipped a bit. Turn back the clock a little bit more. During the general elections 2024, market went down. Anyone who bought it would have been really in good money. Russia-Ukraine war, any geopolitical event, that April 7 Liberation Day, when markets fell down. So anything that happens wherein there is a sudden reaction from the market falls, you should be a buyer, not a seller. If you do that, your long-term returns of your portfolio actually increase by 1 to 2%. And that is where it is also very important to have someone to handhold you, to guide you, to tell you that this is not the time to sell. So that is also a job of your mutual fund distributor, to handhold you and tell you that, okay, now the market has fallen, maybe at this point in time value will be a good bet, or a quality will be a good bet, or if the market is going up, then a momentum will be a good bet. So those things generally the retail investor will tend to miss out on. Okay, so now let us come to the Nifty chart in terms of the DMAs. So if you see, the 20 is above the 50, so there is nothing to worry about here. This is the red line is the 50 DMA, and the green line is the 20 DMA. So till the time 20 is above 50, there's nothing to worry. And this blue line that you're seeing is the 200 DMA, which is much below at 24,400. So we got nothing to worry at all. Markets are usually healthy if they're above 200 DMA, and much more healthy if 20 is above 50. So till the time this is holding, I think the market are in a uptrend. Now let us come to the open interest, something that I had discussed earlier. So right now, this is what happened on Friday. As you can see that about 6 crore calls were added versus 2 crore puts. So this is something that we need to be careful about. There have been more call additions than put additions, and because of that, what has happened is that the open interest actually has gone below 1. So if you see over here, the open interest, now there are about 18.78 crore calls versus 15.21 crore puts. So PCR is now at 0.81, which is not a healthy sign, but this is what it is. So markets might not run away in a hurry, but this is what it is showing. And this is one worrying thing which I wanted to show you. This is the FII short data. So FIIs have actually added more shorts. So now they are at about 1.7 lakh contracts short. So they have been steadily increasing their shorts over the last 4-5 days, and they had gone to a minimum 1.38 lakh shorts. From there, the market actually went up, and now they are adding to the shorts. So market is still going up, but I don't know for how long will it going to sustain. Now let us look at the FII data in cash market. So FIIs this month have actually sold 13,652 crores, and this actually includes one block deal also. So if I take that out, then it's going to be minus 20,000 crores odd number. DIs have actually bought double of it, and that's why we are seeing that the market is holding where it is. So this probably needs to change, because if you see last month FIIs were flat, they were just sold 2,300 crores, and this month they've already sold 13,000 crores. So that is something that we need to watch out for. If you look at the Bank Nifty situation, Bank Nifty is doing all right. Bank Nifty is making new all-time high, and it made a new all-time high, I think, on 13th also, and it was almost at a new all-time high on 14th also. The Bank Nifty is the much stronger of the two indices, and if you see in terms of where the indices are from their 52-week highs, you can see Bank Nifty has been consistently making 52-week highs. If you see in terms of the other indices which have not been doing so well, so one name that comes out is IT, Realty, and Momentum and Alpha. These are the ones that have been lagging behind, and also I would say to a certain extent now small cap has kind of joined that league. So small cap, again, the valuations have been high, and that is perhaps the reason why it is still away 8% from its 52-week high. And mind you, this is not the all-time high. So Nifty 50, if you are seeing 0.74, this is just from the 52-week high, not from the all-time high. So from the all-time high, Nifty is again 2-3% away, and all these indices will be much further away from their all-time highs because they had made those peaks. Now let us look at the performance of all the sectors in the market, and this is the performance if you see over the last 1 month. Okay, over the last 1 month performance, if you see, IT has been doing well over the last 1 month, but just simply it's a bounce, because it had corrected a lot, and infrastructure is up 3%, metals has been up 2.9%. so we are seeing this pattern that something that was beaten down too much has been doing well over the last 1 month. But if you look at autos, which has been the star of the last 1 year, has actually not done anything, and financial services, FMCG, have cooled down a bit. So if you see, Nifty itself has not done anything in the last 1 month. It is just up 0.78%. But if I turn the clock slightly back in terms of last 1 year performance, then you will see that auto has been the outperformer at almost 18.8%, and this is largely due to the GST cut that came. If you see, metals has done really well at 18%, financial services at 18%. So these are the leaders of this particular bull run. I have been maintaining that banks and financial services are the ones that are going to lead this bull run, and that is exactly what has happened. Simply because when the market was correcting, then these guys were correcting the least, and when the market actually was trying to make a comeback, then these were the ones who made their all-time highs first. So it was a very clear signal that financials are going to lead this rally, though the next bull run has not started yet. But mind my words that whenever it does, these are the sectors that are going to perform really well, because you can clearly make out in the last 1 year performance also how banks and financial services have outperformed all the other indices along with metals and little bit of autos. So if you know how to read these things, you will know how the next texture of the bull market is going to be, and you can perhaps be positioned accordingly for that. If you look at mid cap, has done really well. So mid cap is up 11% over the last 1 year. Nifty surprisingly is up by 10%, but that is because it fell really badly in last October. So it is showing 10% returns over the last 1 year. But as we move along, as you will see that Nifty started to do well post April, May. So then this number is going to reduce if we remain in this range for longer period of time. Though something funny can also happen, that market also made a bottom somewhere in February and also made a bottom in April. So if I'm not wrong, April was we made a bottom at 21,700 odd, and February was also similar. So let's say if we are at 25,000 even in March, April, that would still mean that the Nifty would have given 20% return over last 1 year. Okay, so that is something that you need to be very careful about if you are just extrapolating last 1 year returns and seeing that, oh, Nifty has been flat for last 1 year. But if you see from the all-time high, Nifty would have still been down. So that is how you have to analyze the data and see, because data can be quite misleading, or you can say that you can perhaps see the data the way you wanted to see it. So last 1 year Nifty returns are 10%, it is showing, but that is because of the huge October fall. So that's the limited point I'm trying to make over here. Now let us look at the other things which are there. Now let's come to the international market. Now this is the most important one, because this is where the entire action is happening. So if you see NASDAQ, okay, closed okay, all right, flat last on Friday. But if you see the NASDAQ performance, I will show you the performance over the last week it has been down. Okay, it has been slightly down, and from the highs, if you see from the highs, it is down substantially. So the high that was made in NASDAQ was 26,000, and we are at 25,000. So that's almost 4-5% correction that has already happened in NASDAQ. But still, if you see, the returns in NASDAQ have been quite spectacular. 5% returns on last 3 months, last 6 months 16%, and last 1 year 22% in spite of this fall. And apart from that, the yields are in control. There is no problem in the yields. The US dollar index is closing it at 100. That is some sort of a problem. Oil is very well behaved at 64, so there is no problem in that. Our currency is at 88.68, so it is within the range. The main action is happening in gold, silver, and Bitcoin. Now, there was a sell-off, huge sell-off that has happened on Friday in silver again. That's down 4%. And gold again overnight, it fell down by about 2%. But the main problem is in something called as Bitcoin. Now, if you see what has happened in Bitcoin, I'll open the Bitcoin chart. This is a Bitcoin chart. Okay, now what it is showing is that if you see the data, last 1 day negative, last 1 week negative, last 1 month 11% down, last 3 months 18% down, last 1 year is also down. This is just showing +6 because intraday there was a high movement. So it last 1 year it has been actually given no returns, right? And the fall has been spectacular. The fall from 125,000, it's now at 95,000. So it's huge, and this is going to have a lot of impact in terms of the world market liquidity, etc., that I have been maintaining. So this is something that you need to be really careful about. Now compare this to NASDAQ, which is given 22% return. Compare this to gold. Last 1 year returns in gold have been 59%. What more do you want? So when people come and say they want to diversify, then I say, please, by all means diversify, but diversify into something which makes sense. Don't diversify into things which are unheard of, or there's no actual use for them. And cryptos, frankly, at least I don't understand that, and I think it's a fad. You'll read Buffett, Munger, anyone, no one is been votary for cryptos. And if you are playing in cryptos, then I would say that kind of taking very huge risk with your money. And when this bubble bursts, it never bursts in a good way. So be very, very careful. If you have to diversify in gold, silver, they should be part of your portfolio. Diversify in international equities, domestic equities. Within domestic equities, there are so many segments. So you should have a well-rounded portfolio. And another thing is that whenever equities go down, gold, silver actually do well, and vice versa. So they are naturally a hedge. Gold is also a hedge in terms of the currency. If the currency is going down, gold will go up. So when you have got such beautiful hedges to take in your portfolio, why would you want to go into crypto and all? And now we are seeing that how crypto is unraveling. For all it might just cross 125 again, but so what? You just don't know what is the intrinsic value of the thing that you're holding, and how is it going to be 5 years from now? No one knows. And there is no earning for cryptos. There is no backing. No one knows who made it or so it's completely avoid, in my opinion. When you've got a hard-earned money, better put it in assets which are tried and tested. Better put it in assets which yield returns. Gold and silver are a different ballgame altogether, because they have been there for the last 5,000 years. Though they don't yield anything, but they are the final store of value. If nothing else works, gold and silver works. And we have seen time and again how currencies worldwide collapse. Then gold is the one which is still holds its value. So diversification is very important, as I said, and sensibly make your portfolios. Don't add too much risk. There's a very famous quote by Munger, which says that at 25, if you're 25, then risk is a teacher. If you're 55, risk is a predator. So that you should ensure that if you're in your 20s, fine, maybe you have time to recover. But if you're in your 30s, 40s, 50s, then you don't want to lose your hard-earned money into cryptos or whatever be it. So be careful on that count and see how you need to make your portfolio. So coming back to the markets are looking okay. We need to keep an eye out on FIIs. If there's a huge sell-off in the global markets, then we need to be careful about. Otherwise, domestically, everything looks okay as of now. And let's see how the next week turns out to be. Should be okay if the global cues are supportive. Otherwise, even if there's some correction, it could be a good buying opportunity. So that's it from me now. If you like my video, please do subscribe to my channel. If you want to make your mutual fund portfolio, if you want any advice on the mutual fund portfolio, please do fill up the Google form. And I shall see you soon with another update. Take care. Bye-bye.